Here are the components of major trend reversal. First of all, you need a major trend. In this case, we have a bull trend. And next, you have to have a break below the trend line. So we have a bull trend. Every trend has a trend line. And you wait for a move down that's strong enough to break below an obvious trend line. Then you wait for a resumption of the trend. And you're looking for the resumption of the trend to fail somewhere around the top of the trend. It might fail a little bit below, a lower high. It may fail exactly at the high, a double top, or it may go above the high of the prior trend and then fail and create a higher high major trend reversal. And then you want to see a good signal bar. If you're looking to sell in a bull trend, you want a bear reversal bar. You want a bear bar closing on its low, and you want it to have a reasonable size body compared to the other bars on the slide. Almost all reversals are some variation of a major trend reversal. For example, here we have a triangle. You can call it a wedge bull flag. You can call it a triangle. If I drew the line using this low, it'd be a triangle. If I draw it like this, you can call it a wedge bull flag. You can call it a double bottom, higher low major trend reversal. So you got a double bottom that is a higher low above this low. And you could simply call it a higher low major trend reversal. So you have a bear trend, a break above the bear trend line, strong enough to break far above the bear trend line, and you could buy above this bar, stop below the bottom of the bull trend, or you could take a second entry here above this bar. The trend continued up. You got 1 push, 2 push, 3 push, 4 push, and we're trying to get a bull breakout above the top of a bull channel, 75% chance it's going to fail within 5 bars. And then we got a breakout to the downside. I could draw a trend line just across these bars. I could draw a trend line from here across there. What's important here is that you have a very big sell-off. It doesn't break far below the trend line, but it does fall quickly from a very high price. So that's pretty good selling pressure. Can you sell here below the wedge? It's a micro double top. We went up on this little bar and then down, and then we went up much more here and then down. So it's a low too short at the top of a channel, so it's a wedge. You can take that as a short. Arguably, it's a higher high major trend reversal. Bull trend here, bear break, higher high. When the channel is this tight like this, that is a low probability trade. However, now we're coming up again and we're getting a series of tops. You can call it a double top, small double top, lower high major trend reversal. You can call it a head and shoulders top, left shoulder, head, right shoulder. Every head and shoulders top is a lower high major trend reversal, every one. Not all lower high major trend reversals are head and shoulders tops because they don't always have a left shoulder. But anytime you have a left shoulder, a head, and a right shoulder, it's always a lower high major trend reversal. So you sell on the reversal down, especially you got a first entry short, not so good. Channel up is very tight here. And then a second or third, this is better. You have a bear bar there. That's a higher probability short. Looking for at least a second leg down. Anytime you have 3 pushes up, you have functionally a wedge, even if it does not look like a wedge. When you get a reversal down from a wedge, chances are you're going to get at least 2 legs down. So 1 pullback, 2. You need context. What I'm looking for is a bull trend. So if I'm looking to sell a major trend reversal, I first need context. I need a bull trend and I need a break below the bull trend line, preferably as strong as possible, preferably a lot of bars. 5 bars, maybe. Here we got 20 bars. So there's a lot of movements. Even though it's mostly sideways, it's still a break far below the bull trend and for a lot of bars. Ideally, you want the break below the bull trend line at least to get down to the moving average. Sometimes it does not, but the further down it goes, the more bars it has, the more signs of strength that the bears have, and the more likely the bears are to take control. So I want to see a break below the bull trend line, and then I want to see the bull trend resume, and I want that resumption to fail. Here it's failing at a new high, so it's a higher high major trend reversal. This is a lower high major trend reversal, and It's a second entry short. There's a first and then a second below that bar. You can also call it a second entry here. First entry here, second entry there. So it is okay to sell here. And you got a second leg down, one pullback, two. You can call it a wedge, 1, 2, 3, and 2 legs down from the wedge. 40% of major trend reversals result in big swings. 60% of major trend reversals lead to minor profits or minor losses. And this is an example of a minor profit. This is, I think, a very helpful point. Look at the high of this bar. There's a gap between the high of the bar and the moving average. So that is a gap bar. All of these bars in here are gap bars. So there's a gap between the high of this bar and the moving average. And that's a sign of strength. If the bears not only break below the bull trend line and below the moving average, but are so strong that they can put bars completely below the moving average, that is a sign that the bull trend is weakening. And usually, if you get gap bars in a bull trend like this, and the bull trend resumes, that resumption usually leads to a major trend reversal or an attempt at a major trend reversal. Once you start getting gap bars, probably the bull trend is about to end or at least transition into a trading range. Here, it turned into a bear trend. You can redraw the trend line, and you can call this the break below the trend line. Then we've got a resumption of the bull trend. And you got a couple attempts to turn down, 1, 2, that's a second entry short, so slightly higher probability. And you have a decent sell signal bar as well. Now, every major trend reversal top is a variation of a double top. Most double tops are not perfect. In fact, perfect double tops are pretty unusual. So this is a micro double top right here, where the second high is above the first. This is a double top where the second high is below the first. It's a lower high major trend reversal. We have a bull trend, a bear breakout, and then a lower high, a micro double top in the lower high, and a second entry short below that bear bar. So every major trend reversal top is a variation of a double top. Whether or not the second top is below, exactly at, or above. Okay, here we have a bull trend, a break below the trend line. Not many bars breaking below the bull trend line, so probably a minor reversal here or here. Remember, a minor reversal means a pullback or a trading range instead of an opposite trend. These are minor reversals, up and down, up and down, up and down. And at this point, once you start to get about 10 bars after breaking below the moving average, then you got to be thinking about the possibility of a major reversal. Also, once you get a tight trading range that lasts about 20 bars, the probability of trend resumption up is less than it once was. It's now almost 50%. It falls to about 50%, which is about the same as the probability for a bear trend reversal. A bull trend and then a tight trading range lasting 20 bars, any trading range lasting 20 bars or more, bulls have lost control. They might have a slightly higher probability of having the trend resume up, but it's basically a 50-50 chance that the bull trend will resume or the trend will reverse. You have a bear sell signal bar here, which is good. So even though you're in a tight trading range, it's reasonable to take that short. What's the probability of making money? Most of the time, most major trend reversals have about a 40% chance of leading to a profitable swing trade. The other 60%, small loss, small win, and they basically cancel out. If you want a higher probability trade, well, don't sell there. That's 40%. Wait for this. You have a very big bear bar closing on its low, closing below the lows of the past 20 or 30 bars. This now has a very high probability of being a profitable short. You put your stop maybe above here, maybe above here. Those are both reasonable stops. And at this point, you have a 60% chance of getting at least some kind of a measured move down. So maybe leg 1, pullback leg 2, maybe based upon the height of this bear body projecting down. If you wait to sell, once you see the strong bear breakout, the probability goes up considerably. It's a much higher probability short here after a big bear breakout than it is here while you're still in the tight trading range. What's the trade-off? Well, the trade-off is, first of all, your stop is further away, so you're risking more, and you're also entering much later in the trend, so your reward is less. By taking the high probability short here, you are getting a worse risk-reward profile, and that's okay. So you can either sell that close, or you can wait for a couple small legs up and then sell below the bear bar and the reversal down. Now we have another pair of big bear bars closing on its low, closing below these lows, high probability short that we're going lower. Here you can call it a low 2 short, leg 1, pullback, leg 2. You can also call it a wedge, leg 1, pullback, leg 2, pullback, leg 3, doesn't matter. It's a lower high. We're getting a series of lower highs, we're getting lower lows. I think it's a reasonable short below that bear bar for another swing down. So here we have a bull trend, and we got a break below the trend line. But this first reversal down becomes a bull flag. It's simply a pullback in the bull trend. You need to have the bull trend resume and then fail again around the prior high. This pattern is not a particularly big pattern, so at this point you don't know if it's going to be a major reversal or simply a minor reversal in a trading range. But it is a reasonable short. You got a wedge top, 1, 2, 3, a break below the trend line. You have many bear bars. Trend resumption up that's not particularly strong. The bull bars are not all that big, and the bodies are shrinking, and then you have a big tail on top. You can see traders sold here, they sold here, they sold here, and they're selling here again, and you got a potential for a major trend reversal, so it's a reasonable short. Higher probability, you wait to sell after you see a very strong bear breakout. Here we got 3 bear bars, and this one's even becoming larger. Probably at least one more leg down, and here we got a couple legs down. As I said, you can call this a wedge as well. Although you don't have to think of it that way, you can simply call it a lower high major trend reversal. I said that a reversal of a major trend, you want an opposite major trend or swing, but you only have a 40% chance of a swing trade in the opposite direction. With you selling here, you have a 40% chance of a swing down, 60% chance that will just go sideways, and you either get stopped out with a small loss or you exit, you give up, and you take a small profit. But 40% of the time, you get a swing trade. One of the big advantages of trading major trend reversals is that time is on your side. You can see it unfolding. You have a lot of time to anticipate it. You have time to think about the trade. And the management is relatively simple. It does not take a lot of rules. So bull trend, strong bear breakout, and then we have a resumption of the bull trend. This is pretty strong. 4 bull bars. One is a particularly big bar. I would not sell below that bull bar. I would wait to see if we get a micro double top and then look to sell. And I would prefer to sell below a bear bar. And that's what we have. One high, and then we go down, and we go up again with this bull bar. So now we have a micro double top. I would rather sell below a bear bar, so below that bar.